Holy smokes, everyone. Welcome to another Market Open live stream. We got Christine Lagarde. She's speaking at the moment, giving an update after the ECB made their decision to hold their cash rate, not to lift interest rates. But as she started speaking, we're starting to see the European markets are going down. Also at this time, we're seeing in the pre-market, the futures are looking like they're going down as well. So let's go ahead and switch over to Christine Lagarde to see what she's saying here, because things definitely aren't looking good.
Jointly prepared and published in one of your colleagues' newspaper. And of course, I've read it. And we also have taken a view within the Governing Council of the European Central Bank concerning the Growth and Stability Pact, because we have an interest in how fiscal rules will be applied. We have an interest in the governance of the euro area, and we are very keen to see as much of a fiscal union as is possible, given that we have a monetary union, and that the current crisis has demonstrated amply that when monetary and fiscal policy work in intelligent synchronization, it can be very efficient. But I'm not going to pass judgment on a proposal or the other, however respectable the authors are. We have said, us Governing Council of the ECB, that we would like to see rules that are simpler, that are more user-friendly, that provide for counter-cyclical response. And we have also said that we believe that a fiscal capacity would be appropriate in order to respond collectively to shocks. So, you know, there are other proposals that are being floated, but the decision will ultimately depend on what the leaders are prepared to compromise and are prepared to accept. From our perspective, the more fiscal union there is, obviously the better for our monetary policy. Thank you.
Thank you, Madame Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. Can you hear me?
Yes, I can.
Great. I asked this question in December. I'm going to ask it again. Forgive me, but do you think the market in pricing several rate increases this year by the ECB has got ahead of itself? And secondly, can you tell us what your view is on the impact of tensions between Russia and Ukraine on the economic outlook, and particularly the outlook for inflation? Thank you.
Well, thank you very much. I don't know what answer I gave you to the December question, and I might be giving you a similar answer, although it will be in the light of different indication from the economic situation, and certainly different inflation numbers and different labor market numbers. But when it comes to interest rate hikes, we have a forward guidance which has been approved by the Governing Council, which identifies three pillars or three criteria, if you will, that need to be satisfied in order for rates to be hiked. And I don't want to insult you by repeating those three criteria, but I will, actually. So we have the inflation at target, which is 2%, well ahead of the projection horizon. We have, second, the durability, so that we see it staying at target until the end of the horizon. And third, we need to see underlying inflation that is sufficiently strong to determine progress towards target. So we will apply these three criteria at each and every step of the way, and we will determine if and when they are satisfied in order to possibly hike rates. But don't forget that we also have a sequence. And the sequence is that we will not hike rates until we have completed net asset purchases. So I think, you know, what comes first comes first. We have to look at net asset purchases. We are conducting a step-by-step glide of those net asset purchases. We will determine in March what is the assessment, what on the basis of the data that are then available, and we will see what pace, what speed, what amounts we will apply to this net asset purchase programs for the rest of 2022.
Futures have taken a hit since you started speaking.
You asked me a more political question on which, I'm not going to take a political stand, but I will simply say that, the geopolitical clouds that we have over Europe, if they were to materialize, would certainly have an impact on energy prices, and through energy prices, an increased cost throughout the whole structure of prices. But it would also impact growth as a result of reduced income and possibly, as a result, reduced consumption and deferred investment. So the pure economic impact would be certainly significant than what we are seeing at the moment in terms of prices. So we are very attentive to that. And by the way, we include that in our scenario when we prepare the projection and the work that is submitted to Governing Council members at the time of the next Governing Council meeting. I will say separately that peace is a lot better than any kind of war from an economic point of view, and I've seen that in other parts of the world in previous lives.
Thank you, Madame Lagarde. Next question goes to Mark Schröers of Börsenzeitung. Mark, please.
Yes, hello. Thanks for taking my questions. The first one is on inflation. You mentioned several times now the upside surprises in inflation in December and January. Does that mean that the December projections from the ECB staff, that they are already outdated, especially the projections that inflation will fall below 2% in 2023 and 2024? And my second question is on the degree of monetary policy accommodation. If inflation is significantly higher than expected, this means that real interest rates are lower than thought. So monetary policy is more expansionary than thought. Isn't that in itself a reason to recalibrate monetary policy and to tighten monetary policy? Thank you.
Well, thank you for your two questions. On the latter one, it's obvious that monetary policy has to continue to support the economy. And you mentioned it yourself, the whole panoply of instruments that we use that are currently working is also explaining some of the good results that the economies are showing at the moment. On the upside surprise, we did not only use the word upside in relation to surprises, we used it in relation to risk. Risk is to the upside in our projection. We hardly ever, I don't know, I'd have to double check in the last 20 years, we may have in the past, but in the recent past we have not actually mentioned, we have not included in our monetary policy statement the characterization of risks in relation to inflation. So I think that is a very explicit indication that it might very well be significantly higher than what we had expected over the course of the year, and possibly higher than we had anticipated at the end of the year. So risk is to the upside, in particular in the near term.
I thought it was transitory, everyone.
Thank you, Madame Lagarde. And the next question goes to Johanna Träg of Politico. Johanna, please.
She finally
we can't hear you, Johanna.
Can you hear me?
Yes.
Nervous.
Great.
Nervous.
Thank you very much. I've got a quick question on your March projections that you've highlighted now repeatedly. If those updated forecasts show inflation exceeding your 2% target in 2023 and 2024, would then, in your personal view, that be a reason to start slowing bond purchases earlier than currently suggested? Thank you very much.
Well, thank you for your pointed question, but I'm not going to speculate on what the Governing Council will decide. I think you have the answer, but I'm not going to here speculate on what the decision will be.
Thank you. The next question goes to Andres Stumpf of Expansion.
Euro
Andres,
market
please.
started trending down as she's been speaking, for those wanting to know.
Hello, can you hear me?
Yeah, very much so.
Okay, I was wondering, in light of these new events, that if you have measured any kind of what degree of monetary contraction could cause the decision of ending the special rate period of the TLTROs.
Actually, we have not discussed TLTROs at all in this particular Governing Council meeting. And it's one of the items that I'm sure we will debate at our March meeting or later, actually. Because I think they end in June 23, if I recall. Huh? Yeah.
Thank you. And the next question goes to Mark Boinderman of NRC Handelsblatt. Mark, please.
Yes, thank you very much. In the beginning of the press conference, you said
I wish
that
we
there
could ask
was a
questions.
unanimous concern within the Governing Council about inflation. Just to be sure, does it mean that the monetary policy decision taken today was also taken unanimously? And my second question, if I may, to what degree does the scenario or the risk of rising bond spreads determine the pace of normalization of monetary policy of the ECB, especially given the fact that the sovereign debt has exploded so much during the pandemic? Thank you.
Thank you very much. I think I said that there was general concern around the table about inflation and the impact it has on our fellow Europeans. Equally, there was general consensus about the outcome of our decision. I wouldn't call it a monetary policy decision, so to speak, because what we are doing is we are continuing the normalization of monetary policy, and we are considering what will possibly happen and what options we offer ourselves, what optionalities will be around in response to the uncertainty at future monetary policy meetings. That's what we did in depth and very thoroughly today. But there was general consensus on these issues around the table, I can assure you. Now, you asked me a question about the spreads. I would like to just observe that we are not seeing any such development. And while yields have moved up, spreads have not widened in any significant manner. So we very much look into these matters very carefully, and we have no reason to believe that it is going to be different. And if it was, we are obviously going to respond, and we have all the tools, all the instruments, and the adequate flexibility if it is justified. Thank you.
Thank you, Madame Lagarde. And the next question goes to Klaus Rainer Jakisch of ARD Television. Klaus Rainer, please.
This is the ECB Q&A after their decision to
cannot
leave
hear you, Klaus
interest
Rainer.
rates at zero, like what the Federal Reserve does.
Can you hear me now?
Yes.
Oh, I'm sorry. Good afternoon. Thank you very much for taking my question. Ms. President, I would like to focus on the energy prices. If I listen to you and your colleagues, one always has the impression that energy prices is something a central bank can't do much about it. It has to be taken, and this is partly taken as justification for the current monetary policy. On the other hand, one could argue that the current policy is leading to the fact that the dollar is rising quite significantly against the euro. And since most energy, or many all energy, is being calculated in US dollar, it basically is another factor why energy prices are rising. So there is a criticism that one could argue that the current monetary policy stance of the ECB actually is fueling inflation rather than combating it. I hope you won't just say we don't focus on the exchange rate, but what do you say to this criticism? Thank you very much.
Well, thank you very much. And it is the case that the very high inflation numbers that we observe are at least 50% caused by energy prices. Oil, gas, electricity, and they all interrelate, gas having a stronger bearing than in previous years because of the price mechanisms depending on the length of contract and all the rest of it. I will spare you the details. But 50% of the current inflation is caused by energy prices. If the ECB was to, first of all, reduce and finish its asset purchases, then raise interest rates in short order, do you think it would have any impact on energy prices? No. It is not in the ambit of monetary policy to decide the price of the barrel that is organized predominantly outside of Europe. Now, true that most of those contracts are in US dollars currency. But if I look at the significant appreciation, depreciation, it varies a little bit. The euro has depreciated a little bit. I don't want to, be in the wrong numbers, but it's no more than 3% over the course of the last 12 months. So I don't think that, we can attribute to the European Central Bank the high cost of energy, which impacts 50% of the inflation and the price paid by the consumers. Having said that, the European Central Bank and its governing council at large are focused on its mandate, which is price stability. But we are going to stick to the objectives that we have, that is set by the treaty, that is price stability at 2% in the medium term. And believe me, as soon as it is required and the conditions are satisfied, we will act because it is our duty, and we shall do so.
Thank you. Thank you very much. Next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for the opportunity. President Lagarde, I have two questions. The first question is on the lower bound. If inflation were to be too high relative to the 2% target, the ECB would respond. And your response will come from the lower bound and from negative interest rates, which is very exceptional. Can you tell us how the central bank, the ECB, can respond to higher inflation coming from the lower bound? And my second question is on your step-by-step approach. The Governing Council expects net purchases to end shortly before it starts raising the key ECB interest rates, and that is APP net purchases. What does this shortly before mean if inflation was going too high for too long? Thank you.
Well, how do you hike interest rates? By hiking interest rates. And clearly, we will have a very sophisticated, determined approach and analysis to doing that. And we will only do that in the sequence that we have fixed for ourselves and which has been agreed, which is that we will look at net asset purchases first, gradually, okay, on a data-dependent basis. And then we will look at interest rates. Now, you asked the question about net asset purchases, and I'm not sure exactly what your concern was about the net asset purchases and what is the
a bit low.
What was the question?
What shortly before?
Oh, shortly before. Yeah, of course, shortly before. Shortly before is probably a little shorter than just before. And that, again, is going to be, in the estimation of the Governing Council, data-dependent and based on the assessment that is conducted. But I would say this, we are not there yet, for the reasons that I have just mentioned, which is that we will be very faithful to our sequence. We are still conducting net asset purchases. We will stop the pandemic emergency program net assets in March. And then we will look at the net assets under the APP. So don't assume too much in terms of immediacy of hikes. We will not be complacent, but we're not going to be rushed into a process. We will follow the sequence that we have set for ourselves. We will verify the forward guidance criteria, and we will be gradual in whatever we do.
Thank you, Madame Lagarde. And today's last question goes to Jean-Philippe Lacour of Jean-Philippe
Lacour question, then we get into the market open, baby.
Jean-Philippe, please.
Okay, thanks a lot, Wolfgang. Good afternoon, Madame President. So it seems very crucial to avoid the so-called second round effects in the setting of wages and prices. And in times where we see people going on the street and to defend their purchase power, especially in France, would you go as far as to call the unions to wage moderations in the coming period to avoid this second round effects, which are not yet there, of course? And the second question is, we have an interview of World Bank Vice President Carmen Reinhardt today in a Spiegel, using harsh words toward the central banks, telling they are only independent on the paper. And for that, she said that the level of public debt is so far so high, then the central banks are so hesitant to act, here. What's your take about this? Thanks.
Well, on the latter question, I have not seen what Carmen has written, so I'm not going to comment on that. She's an expert on sovereign debt, and she has held that view for a long, long time that excessive sovereign debt is.
You know what, guys? She's pretty much just repeating the same thing over again and again. So for those of you that don't know, Christine Lagarde, she's the head of the European Central Bank, and so they just had their rate decision after the Bank of England. The Bank of England did their first back-to-back rate hike, so they have now lifted interest rates to 0.5%. And really, I think the Federal Reserve should have been lifting interest rates at the same time. But you got pretty much Lagarde here saying the same thing the Federal Reserve was saying, or don't worry, it's temporary. And for those who don't know, they were expecting inflation to be 4.4%, but now it's actually increased to 5.1%. And so they're saying the same thing, excuses, don't worry, it's just supply chain issues. Majority of the increases is due to energy, which is saying is really out of their control with the energy crisis in Europe. But she did admit, and she sounded pretty nervous, that inflation risks have tilted to the upside. But also what she's using as an excuse, she's saying that wages aren't going up enough for inflation to be entrenched. So we'll go ahead and we'll see what the futures are doing, and we'll get ready for the market open here. I think the bell's going to be starting soon. Let's see if Bloomberg has it. I'll bring it up now.
And where, gradually the output gap is closing, and there is less and less slack in the economy. So we are waiting for that movement on wages. And our duty, of course, is to make sure that through a second round effect that would not be addressed by monetary policy, inflation would run out of control and would spiral. This is not what we are seeing, and we certainly don't want to see it. But I'm not here saying that there should be wage moderation. There is clearly an adjustment to be had, which I'm hoping we will see in the course of 22. That would be the economic logic of what we are seeing at the moment. And by the way, as I'm finishing on that question, I think we should be a little bit cautious about what I'm hearing a lot, which is constant comparisons between the US and the euro area, the Fed and the ECB. We are really operating in different environments with different economic data. Just to give you an example, our demand here in the euro area is pretty much back to where it was pre-COVID. In the US, it is 30% up. Ask yourself why. Because of this massive fiscal stimulus that the US economy has had. Unlike the euro area, where it has been more moderate, not excessive, and which is producing the sort of measured pace at which some factors are significantly improving. So, suffice to say that I wish you all a very, very good day. Thank you.
Thank you very much. That brings us to the end of our press conference.
The situation has changed. The ECB president there, Christine Lagarde, out of Frankfurt, Germany. In much of the last decade, over the last 10 years, that is the closest this ECB has come to even thinking about raising interest rates. That's the opening bell in New York City. Good morning to you all. Let's whip through it. Euro dollar spikes higher, up 0.7% on euro dollar 113.83. As we bring forward the prospect of interest rate hikes of the ECB, at least the thought of it, this is what it does to the German debt market. Switch up the board and get to Bunds. Bund yields higher at the front end and right through the curve. On twos, up 6 or 7 basis points. Now negative just 39 basis points on German twos. The depot rate of the ECB still negative 50 basis points. The problem might be in Italy. Switch up the board and get to BTPs. Your 10-year yield in Italy higher by 15 basis points. At the front end, up by 14.
So let's go ahead and have a look at the US markets. Let's see what's happening here. They're talking more about the European markets. Okay, so the markets are open now, according to CNBC. Yeah, it's a pretty red open today. We've got the NASDAQ down 2.28%. This is what I was thinking with the big sell-off in Facebook, with PayPal, with the tech stocks. The Russell's down 1%, S&P down 1.46%. Oh, it's accelerating now. And the Dow's down just 150 points, down 0.4%. So let's see what they're saying here, why stocks are falling. So stocks fall for first day in 5 as Facebook spoils tech comeback. Okay. All right, let's see if there's any breaking news for reasons why. So, yep, Meta has plunged 23% in the pre-market, which I've already gone over. Really feel bad for Kevin O'Leary buying Facebook after he just lost a big amount on PayPal. So we got pretty unlucky there. And thanks for that super chat, Shalom. Alrighty. Okay, so yeah, pretty much all the same stuff. They're talking about earnings from Alphabet, Apple, Google, Microsoft. Okay, so other social media names, including Snap, Twitter, followed Facebook shares low on Thursday. Snap shares slid 15% in the pre-market, and Twitter dropped 6%. So, yeah, these social media platforms aren't doing well. Spotify also fell. There's a lot of controversy going on with Spotify at the moment, down 9.6% in the pre-market. Okay, let's see what else is going on here. Yep, so in the Dow, Honeywell shares fell 3.1%. So that's why we're not seeing the Dow fall that much as well. So this came in, economic data, US jobless claims came in at 238,000 for the week. So that was slightly better than they expected of a fall of 245,000. And that was better than the 260,000 before. But we did see that other ADP jobs report where 300,000 jobs were lost instead of the 200,000 gain they were expecting, which is what we're seeing here. And we'll get another report tomorrow. Let's see, what's Bitcoin doing? So Bitcoin has been trending down with the NASDAQ as well. I'll move myself over here. We're down to around 36,500. It did hit a low of around 36,200. So again, it is highly correlated with the NASDAQ and with the tech stocks. Let's see what the dollar's doing. Okay, so the dollar's starting to trend down a bit. Down a bit now as well, down 0.36%. What else is happening? Is there any other breaking news? Let's have a look here. How are we all going in the chat anyways? If you've got any questions, just let me know. So yeah, we see the Euro markets. For those wanting to know, the DAX is down 1%. That's the German market. FTSE is down 0.3%. CAC is down 1.4%. And the Stock 600, that's just a mix of European companies. That's down 1.35%. That really started trending down when Lagarde started speaking. So let's see what's going on with oil. Oil's down a bit, down 0.5%. Gold. So gold's down a bit, 0.4%, but silver's getting hit harder, down 1.26%. Let's see. So the yields on the 10-year Treasury are spiking. So the yields are now back up to 1.83%. I did think they hit a low of around 1.74, if I believe. And yeah, we see Ethereum down 3.5% as well to 2,600. So let's see what's going else here. Why is the dollar dropping? I think could be because of the weaker economic data that we've been getting. And maybe they think the Federal Reserve won't lift interest rates and they won't tighten as much. And so then that puts downward pressure. Obviously, if interest rates go up, there's more demand for dollars if the yields are higher. So, yep. As we saw here already, Facebook shares plummeted 24%. Okay, so it's now down 26%, people are saying. What else is going on here? I'm just looking at the chat here, guys. When's gold going to rocket? That's the question. I think if we do hit a recession and people get scared by the stock market crash, then we'll see a flight to safety like we saw in March 2020. But during the stock market sell-off, sometimes gold sells off as well as people cover their margin positions, especially with stocks falling so quick, like Facebook. I'm sure a lot of them getting margin calls. So what's this 5 things to know today? What's the 5 important things we should know? Thanks for that super chat, Gus. Hello from Los Angeles. Thanks for your report. Let's go, Brandon. Yeah, thanks for that. Alrighty. So yep, that's talking about the futures plunging. Again, talking about the social media platforms. See anything else? So also what happened with Facebook, a reason why their shares been plummeting, because they lost about $10 billion with their metaverse business. So that's bleeding money at the moment. And I don't know about you guys, but these metaverse games, they look terrible. And really, the metaverse is nothing new. It's like kind of like if you any of you's played games like MMORPG games. It's just like playing a computer game. It's nothing really too fancy. You know how they say don't put your eyes too close to the computer screen or too close to the TV. When now people are going to be having these screens with these VRs right in front of their eyes, so that can't be good. But yeah, I don't really know anyone that's spending heaps of time in the metaverse right now. What else? Yep, just talking about earnings for the Dow. A couple of stocks down. Initial jobless claims. So Biden's pick for Fed Vice Chair of Supervision to go before Senate. So who's he going to pick? Sarah Bloom to be the next Federal Reserve Vice Chair for Supervision. Raskin, a former Fed governor and senior Treasury Department official who is strongly backed by progressive Democrats, has become a lightning rod for criticism from business groups and fiscal conservatives for her views on climate change. Her husband, Maryland Rep., served as lead Democrat prosecutor for the unsuccessful 2021 impeachment trial of President Trump. So let's see what these new Fed chairs do. If they're going to be more hawkish or more dovish, because we know Biden, he's definitely wanting to, he definitely wouldn't want to have interest rates going up right now, because he definitely wants to spend. But that's going to just be more fuel in the fire for inflation. So let's see what else is going on. Let's go back to the markets. Okay, so it looks like people buying the dip here. The Nasdaq's up just down 1.8% now. S&P down 1.18%. And the Dow's actually selling off a bit more now, down 0.5%. So I think that's pretty much most of the news. Done some videos today on inflation, what's going on with UK with their gas prices spiking. Also did a video on Kevin O'Leary's bad call after making a big loss. I'll switch here with PayPal and then going in going in on Facebook right before the earnings call. So that was pretty funny. And I've got another video coming out probably in about 7 hours about the Fed. So yeah, you guys got any questions? Let's see what's going on in the chat here. My thoughts on Charlie Munger buying into Alibaba. It's definitely a risky move, but I know he's been pretty friendly with China. And that's something I'm definitely seeing with a lot of very influential business people, like we're seeing with Ray Dalio. I wouldn't be surprised if China's not just buying real estate in foreign countries. I wouldn't be surprised if they're not buying high level executives and even politicians as well, because there's definitely some people that you can tell that they're overly enthusiastic for China. Let's have a look what's going on with ARK. Someone's saying it's still falling. So yep, down 2.3%. So it was down lower, but it is bouncing a bit. But let's see how much it is down now from its high. So yeah, down 54%. Is it time to buy the dip now, everyone? It's already been smashed 54%. Or do you think it still has ways to go, like in the dot-com bubble, where stocks crashed 95%? Yeah, that's right. Gas prices are definitely going higher. And it's going to be coming everywhere, but it's really bad in Europe right now. So I'm in the UK speaking to a few people at work today. They're really concerned about these energy price increases. A lot are already just about getting by. Now worry about social unrest. Yeah, definitely. That's what I've been talking about. These price increases are unsustainable. And, these central banks are just saying, suck it up. It's only going to be temporary. But people in the middle class, their budget's already so tight. I don't know how they're going to afford a 50% increase. See what else you guys are saying. No, I don't really look at Blackstone stock. Yeah, definitely. Tom, with the homeless crisis, it's definitely getting worse. And I've seen in some places rents are going up by hundreds of dollars a week, and I've seen some places rents have doubled over the past 2 years. Yeah, that's right. Property taxes are going to be going up, so a lot of people that FOMO'd into their home, they thought they could afford the mortgage. Well, their property taxes are going to be going up, and in Australia we call it council rates. Let's have a look at PayPal and Facebook. So yeah, PayPal's still going down now, down 2.7%. Let's see how much it's down in the month. Geez, 33%. Over 6 months, down 56%. 58% from their recent high. Is it time to buy the dip there, everyone? That's a pretty good discount. Let's see what's happening with Facebook. Damn, 25%. Look at that, it's fallen off a cliff. Yeah, it's definitely getting punished hard. But definitely seeing Facebook on the way out. Not many people are using Facebook anymore. I did acknowledge Wolf for the $10 super chat. Alrighty, what else? What else you guys want to know? So the opinion on the housing market, it's all going to depend on what the Federal Reserve does with lifting interest rates. If they do go about it and start lifting interest rates, we will see a softening in house prices, especially with there's already been so much appreciation. But it all depends on how much they're lifted. If they lift interest rates 5 times this year, well, then that'll be an increase of about 1.25%. So there's also other factors that come into it. The housing market in the US is such a big market. Every state has their own housing market, and every city in the state has their own housing market. So you have to really look at the fundamentals in your area, look at the days on market, look at the supply coming on, look at the construction in the area. But definitely, if interest rates go up another 1%, we're going to see a weakening effect on the housing market. All right, everyone, I'll take a few more questions, and then for me in Australia, it's 1:45 in the morning, so I'll call it a night for me. I'll have one more quick look to see what the markets are doing. So yeah, we're actually seeing the Dow starting to trend a bit down more now as well, down 0.73%, S&P 1.4%, and the Nasdaq down 2.1%. So we'll see. Will the dip buys come in and save the day, or will the plunge protection team come in to save the day and bring this market in green, or is the sell-off going to get worse? What do you think, everyone? I'm in Victoria. Let's have a look here. Tesla's down below $900 again. Thing with Tesla is there's just such a huge cult following. So you think the stock's just so overvalued, but if people want it desperately and they're willing to hold it and never sell it, that's what is supporting the price at the moment. But yeah, I just definitely see these YouTube channels, they only do Tesla, and people just love Elon Musk, and they'll just buy it no matter what. So I guess that's why the stock has been so overvalued for so long. All right, everyone. Well, I think that'll do for this market open. I don't know how many of these live stream I'm going to do, but I thought we had some interesting news with what was going on with Europe, what was going on with the UK central bank, what was going on with the ECB central bank, and what's going on with the markets today. So thanks for watching.